After talking about the recent banking sector developments, the Fed Chair Jerome Powell elaborated on the broader economy and Fed's monetary policy.
He reiterated that inflation remains too high and the labor market continues to be very tight. Fed is committed to bringing inflation back to 2%.
Price stability is Fed's responsibility, and that's needed for the smooth functioning of the economy and for sustained labor market conditions.
The U.S. economy slowed significantly last year and the housing sector remains weak. Fed expects subdued GDP growth for this year and next, well below the long-term average growth rate.
Job gains have picked up in recent months and the unemployment rate remains low. The labor force participation rate has edged up in recent months and wage growth has shown some signs of easing. However, the labor demand substantially exceeds the supply of available workers. Fed expects this to be balanced over time.
The strength of the recent inflation readings indicate that the inflation pressure remains high. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. But longer-term inflation expectations appear to remain well anchored.
In the FOMC meeting, the Fed raised the interest rates by 0.25 percentage point, bringing the target range to 4.75% to 5% and is continuing to significantly reducing its securities holdings.
Fed believes that the events in the banking system are likely to result in tighter credit for households and businesses, which would in turn affect economic outcomes.
It is too soon to determine the extent of these effects and so, too early to tell how monetary policies will respond. Due to this, Fed no longer states that they anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, they now anticipate that some additional policy firming may be appropriate. Fed will closely monitor incoming data and carefully assess the effects of tighter credit conditions.
The FOMC participants projected that the appropriate level of the federal funds rate will be 5.1% by the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. If the economy does not evolve as the committee projected, the path for policy will be adjusted as appropriate. Fed will take decisions based on the totality of incoming data and their implications on the economy.
Reducing inflation will result in a period of below-trend growth and some softening in the labor market.
As Mr. Powell mentioned in his previous speeches, Fed understands that their actions affect communities, families, and businesses across the country. Everything they do is in service to their public mission. They will do everything they can to achieve maximum employment and price stability goals.
And that's all for today. Thanks for watching. Please like, share, and subscribe if you found this channel useful.